Right, can you see that?
Yeah.
Okay, so yes, in terms of a little bit, obviously, in terms of myself, firstly, I just want to thank Aruna for setting up this time for me to talk to you all today. I'm just really grateful for this opportunity to present to you, give you a little bit about who I am and what I do. And really, just if you've got any questions, then feel free to ask them in the chat box. We can answer them at the end. And obviously, we want to just try to make sure that you get a good financial education. So this is me. So this is my email address if you did need to contact me. So my name is Manjit Kaur. I'm a mortgage broker at the Mortgage Mum, and I work alongside Mortgage Intelligence for my compliance. So I'm self-employed, and I chose them because they ensure that we are fully compliant. So we're fully Financial Conduct Authority regulated, and I'll make sure that I can give you full advice and recommendation. So if you do want to follow me, my pages, I'm on Instagram, Facebook, and Twitter and YouTube. So, and you can also get me on LinkedIn as well. So I'm sure we can pass the information to you if you do need to get hold of myself. So yes, in terms of myself, so I graduated from university and I've been in the financial service industry for 20 years now. Just working as a business manager, then went on to a bank manager, and then got qualified doing mortgage and protection advice. Became self-employed because I wanted to just have that time with family and have time, in terms of focusing on my clients. So it just means I get a nice work and home life balance. So that's me. And I'm just going to go to the next slide. You can all see that, yeah? Okay, so today what we're going to look at is mortgage financial preparation in times of recession. So I'm not sure how many of you have watched the news today. So this time of the year is an autumn statement that comes out. So you get the Chancellor, Jeremy Hunt, who confirms what he wants to set out and his plans. So he confirmed today that we are officially in recession and we will be in recession for the next 2 years. So today, hopefully, I can give you a small overview, again, not too much in depth. So just an overview for what that looks like. So we're going to look at what is financial preparation. So making sure you are prepared and not just listen to the news and panic and worry, having to look at your own personal circumstance and see how that you can benefit from looking at your own situation. Then we're going to look at the cost implications for everything that's happening. Why is it important to plan ahead? What should you know about rates and interest rates, habits of money? Then we look at where your money goes each month, and then final few tips in terms of what to keep in mind. And then we let you answer any questions at the end. So again, this is what we'll be looking through. And like I said, if you have any questions as you go along, we can catch those up at the end for any questions you've got. Okay. So firstly, what is financial preparation in a recession? So it's a difficult time for some people, and how it works is recession has impacted a lot of things, especially in the mortgage market. What's happened is banks lend you money every, in terms of for your mortgage. And the way they work that out is they look at what's called the Bank of England rate. So if you probably follow the Bank of England rate, you probably see that they are currently at 3%. So what's happened is the Bank of England have had their first highest increase for such a long time. They've increased by 0.7 just recently. So the reason why they increased it is because, if you're probably aware, it's all about inflation. Inflation is impacting in terms of the cost of living, is also impacting now interest rates, our savings. So the idea is they want to tackle inflation. However, the interest rates are going to be high now. This is like this most single high rate increase that's happened for 33 years, so since 1989. So it just means that the level of interest that we are going to pay on our mortgages will be high. So again, it's just making sure that you are prepared and you know what will happen if you are having a mortgage. The idea is really not to panic in terms of, okay, you're thinking, what happened in 2008. So these rates, what they are offering at the moment, those were the rates in 2008. So if you can imagine, in 2008, the property prices were lower and the interest rates were higher. So now property prices are higher and the interest rates are higher. So our monthly payment will be much bigger now. So again, it's just making sure you are prepared and you know what will that look like, and trying to find solution, whether you are buying your first home or you're looking to remortgage, and making sure you have got plans in place and to know what the potential impacts will be. Even if you're a landlord, this may impact you as well. So just making sure that you know. So potentially at the moment, there's about 2.2 million people that are currently on a tracker rate. And I'll explain what these are: tracker rate or a discounted rate. So like a variable rate. So they are directly impacted. And then you have got another 6.9 million people who have got mortgages as well, who are currently on a fixed rate, and their rates are due to come out of their deal in the next couple of months. So you can see it is impacting a lot of people, and the stress levels can be quite high. So ideally, we want to try and make sure that you can benefit. What are the experts saying? And will house prices fall? So the question I get is, oh, do I move? Do I sell? So again, I've just pulled up some latest news articles in terms of what's happening. So if you can see here, Zoopla predict that markets are strong and the supply of available homes was below average. So it's just saying that everyone's not putting their property on the market at the moment. They're holding on. Then you've got Nationwide chief executive here saying that he believes that there'll be a slowly increasing in prices, and the worst case scenario, there'll be a 30% fall in prices, property prices. So you can see there's two extremes there. Again, they're not clarifying in terms of what will actually happen with house prices. They're saying, yeah, it could go down or not. And then you got here estate agent iPlace Global, who says there'll be potentially a 16% likely to sell next year. They're not even planning to sell now, they're holding back. And then again, Zoopla saying by 2023, you're looking at a decline of 5% in property prices. And then lastly, Savills here, they're saying predicted the average UK house price would have a fall of 10% in 2023. But again, they may start increasing in 2024. So as you can see, there's a lot of confusion in the market where one person is saying, okay, there may be a 30% fall. And then somebody like in Savills is saying actually 10% and 5% here. So like I said, no one's got a crystal ball. Nobody knows what will happen. I normally say in terms of when somebody says first time buyer, shall I go and buy that house? Do you think I'll get it cheaper next year? To be honest, when you find a property, you don't know if that property will come on the market next year. So there's always personal circumstance in terms of when buying a property and the reason why you're buying. So if you are a buy-to-let landlord, stress testing by lenders has changed. So which means that when you are remortgaging to another lender or releasing equity out of the property, it may not be possible. Reason being this stress testing, what you would have had this time 2 years ago or even 6 months ago has changed, has become slightly more tougher. Reason why it's more tough is because interest rates have gone higher. So they need to assess whether the rental income will cover the mortgage payments plus additional tax. So yeah, so again, it's always best to get advice for any buy-to-lets. Again, planning and preparing if your remortgage is due at least 6 to 7 months in advance. So anybody, if you're looking at your rates due to expire April, May time, 2023, I would start looking now to find out, is it feasible? At last resort, you can always stay with the same lender. They won't refuse to keep your mortgage on. So definitely worthwhile speaking to a mortgage broker who can give you the advice on that area. So current residential rates, so rates available may be higher now than previously. So 2 to 5 years ago, your rate may have been 2%. Again, 2%, 1% rates, they no longer exist, unfortunately. Though you would have been lucky to have a very even 0.9 rates around, believe it or not. So now, therefore, the swap rates is what they call, is when you're changing your interest rate with the same bank, they will be definitely higher at the end of the term. So if you've got a fixed rate and it's coming to an end, potentially those rates will be higher. And if you are first-time buyers, same impact. Your deposit potentially may be higher requirement because how they're working out affordability is based on potentially the higher cost of living costs going up. So potentially you may need to put in more deposit to then make sure your monthly payments are affordable. But again, this is what we say is get the advice advanced how much you can afford each month. So when you go out and purchase a property, the estate agent first question is, they'll say, have you done a decision in principle? If you have done decision in principle, it shows that you are confident and you know your money figures, and you know your aspects of how much you can afford each month. So definitely important to plan, especially if you're a first-time buyer. Can you afford it? Will it be achievable? And again, estate agents do call me just to verify affordability. And again, I'm more than happy if you want to, get me to call estate agents. That's something that we do to confirm to them you can afford this mortgage and it is all feasible. Again, this is where we do the full fact find and analysis to make sure we can plan and make sure you are prepared. So not only for first-time buyers, planning ahead is also for anybody who has got an existing mortgage. We want to make sure you are prepared and you know if your monthly payments are currently at, I don't know, £500 and they are going to go to £650, for example, in April. You need to be aware of that now and then start thinking, okay, what do I need to do because my payments are going to go up? So again, it's making sure you can plan. Again, there are solutions out there. For example, we can look at maybe extending terms. We normally advise the shorter the term, the less interest you pay back to the bank, but we can do something like extended term to reduce the monthly payments if you think there's going to be a stretch. You can review it every 2 years, a mortgage. Those are normally the minimum term you can do at the mortgage, and then review it again and maybe shorten the term again once your finances have changed. And again, some people ask the question about interest-only mortgages. Again, that's an option as well. But again, it's all tailored advice to the high. So it's safe to say there is a fair amount of confusion around mortgage market. Rates have, risen. So what, potentially you want to do is secure a mortgage rate. But the question then we always get is, is it going to be a fixed rate mortgage, or in terms of, the pros and cons really for fixed rate mortgages and variable rate. So again, the next slide is quite a busy slide, but what I'll do is I can send it to Aruna, and then she'll give you like a blog post which covers all this in there. So you have got that for taking it away and you can have a look at it. So in terms of fixed rate mortgages, how they work is it's the same amount you pay, exactly the same amount each month. The interest is fixed for the remaining term. So it could be, for example, a 2 years or a 5-year term. The fixed rate is what you pay for the duration. So if you think you need stability or monthly payments, this is what we normally recommend. So it just means it helps you budget each month. At the end of the fixed rate term, it normally goes on to what's called a standard variable rate. So the biggest positive about that fixed rate is, that if the gas bill or the electricity bill is going to go up, this mortgage payment will always be the same. And it will be the same until, it could be even 10 years. Some clients take 10 years, some even take a 40-year term because they don't want to worry about what the payments will look like over the term. So those are the positives. So it just means it's much easier to budget. And again, it's just making sure that you can pay what your income is and what your expenditure is. You can plan throughout each month. What happens or not. Again, the main advantage of having a variable rate is that, you would benefit if, the interest rates went down. So if the Bank of England went down, that you'll end up paying less each month. So again, it's just knowing whether you want to take that risk. Some people say they don't want that risk at all. So again, it's that personal choice sometimes, whether having that money aside. So for example, you may think, if you're looking at today's market, comparing it now, rates could be, 5.5% for a fixed rate right now. Variable rates or tracker rates, even discounted rates, they can be as low as 4%. So that 1% per month could mean potentially a £200 saving each month. So again, you have to weigh it up to think, actually, do I want to pay £200 less each month? And then think, actually, in next month, they may increase the rate, which means I may pay an extra £20 or £30 extra next month. So again, it's just really making sure you have a buffer in place, because if the interest rates go, and the prediction at the moment is, so it's 3% now, the prediction is next year will be 4.75. So this is where you need to factor in, can you afford to then increase your monthly payments by that extra amount? So again, it's just making sure that you have got that buffer. We normally say is, okay, you've saved potentially £200 that month, put it aside in a savings. If it does go up, you can actually dip into that savings pot, which you potentially would have saved, and not spend it on something like handbags instead. So in terms of looking at, is it feasible to do a variable rate, and it doesn't fit everybody. It is not suitable for everybody because people don't want the stress of thinking, is my payments going to go up? Do I have to keep an eye on what's happening and tracking? So again, the flexibility obviously is good because some lenders don't have early repayment charges. You can overpay, you can then change to a different lender. Some do have penalties like early repayment charges, but they have a slightly better rate. Again, it's personal choice, and all rates are different depending upon loan to value. But again, we can always give if you do want more information, just give me a shout. Hopefully that's clear. If not, like I said, I can always send you this as a blog, and then you've got information. You can have my email address, and I can email that over. So now what we're going to do is just have a look at money habits. So when we are looking at mortgages, it's important that we look at money habits and making sure you can budget each month. So obviously we said about, especially if you have got a variable rate or a tracker rate mortgage, you want to make sure you use what's called a budget planner. So plan and budget wisely. So again, I don't know how many of you do use a budget plan at the moment. So what it does is it works out your income and your expenditure and what you have paid out each month. Again, we always say review every month what that budget planner looks like, what your income is and your expenditure. Because you may be paying out for, I don't know, a gym membership, for example, but you haven't been to the gym for 3 months. So again, is it actually giving you value? You need to assess what is you're paying out for. And you may not realize when you look at your bank statement, again, bank statements are the key thing to look at. And we do also look at it when we look at your mortgage. What are you spending your money on each month? Is it coffee or is it going out for dinner? Again, it's just looking at that budget planner and thinking, actually, what have I spent my money on this month and what is important to me? So, if you do need a budget plan, I have got like a spreadsheet. So just feel free to just email me. I can send that over to you. So it just covers what the income and expenditure is each month. Yeah. So live within your means. So again, just making sure that, in terms of what you're spending, what I normally say is when you are shopping, when you're shopping online, it's so easy now to just go and buy, shop. It's a click of a button. Your card details are already stored there. I always say, go on to the online shop. Okay, you see something that you like, might be a dress for Christmas. I'm sure everybody is Christmas shopping at the moment for a dress, but then leave it in your basket and then come back the next day and then ask yourself, do I want it? Yeah, I do want it. Can I afford to have it? Then you need to look at your budget planner to see, can you afford it? And do I actually need it? Can I wear something else instead? So again, it's just asking yourself the questions to plan, actually, do I need it? Half the times you probably don't even need it. You've probably got a dress in the wardrobe that you probably worn once last year. So again, just thinking about those things. Can you afford it? Do you need it? Do you want it? And yeah, again, if it's affordable and you can do it, it's options there for you. And I always say these are probably the 4 key areas which you probably can't cancel, which are important. Hobbies, I always say, okay, you still need to make sure you have got that life and work-life balance. So hobbies, make sure you are continuing to have those, have a social life. Don't cancel completely out social life, because you still need to make sure not just paying a mortgage payment, you still need to enjoy time, holidays, breaks. So always factor in any hobbies and interests that you've got. Bills and utility bills, they are definite musts as well. We can't avoid council tax bill. Again, when you're looking at the budget planner, just make sure you have got those in there. Emergency fund and savings. So again, in tougher times, it can be harder to save, but we normally say is just try and save a small amount each month. And if you can, save at least 3 times your salary left in a savings account before you do make any overpayments on a mortgage. So again, it's just making sure you have got that additional emergency fund or contingency fund, we call it, before you go out and overpaying on a mortgage. And, you know, touch wood, if it doesn't happen, if you were to lose your job at any point during the mortgage term, you know you've got this pot to dip into as well. Or if a boiler breaks down, you know you've got this pot you can dip into. So definitely put some money aside. And then insurances, so things that insurances in terms of mortgages, you have what's called mortgage protection. So if you were, touch wood again, doesn't happen, but if you were to die, or if you were to suffer a critical illness, we normally say, again, it's not mandatory as part of a mortgage, but again, it's good to know that is in place. If you were to die, then that money would be, whether it is your children, could be left to your children to pay off the mortgage. You can then, they can then pay off, and then they can live in the property without having any money worries. Other insurances are like income protection. So a lot of people do have what's called income for their, potentially their ex-partner. So if you, for example, have a maintenance payment that they're paying, and if they were to die, then that insurance would cover that maintenance payment, for example. So those are insurances that potentially make sure you don't cancel, and you have got those in place, especially, you know, covering the mortgage and any debt you've got. Again, if you need any advice on that, just, you know, call me and contact me. I can run through those. We don't charge anything to look at insurances from a mortgage broker side. So, last few slides, just to, so plan today really is what my key message is. Plan today, and then you hopefully reap the rewards and benefits later on. So again, it's always making sure, look at your own personal circumstance. Don't worry what other people are doing, panicking. If you have got yourself a solid plan and work out what you can do, you can then feel a bit more focused, and you know what the plan is. And then some final tips and reminders is that, you know, reviewing your mortgage is important. 6 to 7 months reminders is that, you know, reviewing your mortgage is important 6 to 7 months before it expires. So definitely that's something that I would recommend. Ensuring you got your 3 times your salary. So this is in savings, put aside, and always get advice from a professional mortgage broker who can access comprehensive panel of investment, and knowledge pays the best interest. So it normally says knowledge will allow you to make the right decisions. So make sure you have got the knowledge to prepare yourself. So wherever you are going, make sure you are ready and you've got the tools there. So yeah, so just if you do want to connect with myself, so you can get in touch. So us as the Mortgage Mum, we are on Instagram, so you can follow me on Manjit_the Mortgage Mum. I do have also another page, Mortgage House Services, where I do news updates and general mortgage market updates. You can contact me on my mobile or send me an email, and I love to get in contact with you. So lastly, I just want to say is just, stay in terms of, when we look at personal circumstances, we normally say is don't stay in your hole and be confused about your mortgage options. You need to get out there and speak to a trusted person for advice. So really, as we say, is just lose the fear of judgment and go out there and get that professional advice. Because what happens is when things are tough, we naturally go into our hole and start worrying and don't want to look at bank statements and don't want to look at our pay slips or our income expenditure. So you just feel worried about what you can do. So we normally say go and speak to a third party person who will be emotionally involved in your process and can hold your hand and hold you emotionally through the process. And that's what, in terms of, mortgage brokers are there for. They want, they're emotionally aware of your situation. They will equally, give you, the practical advice. And then, they'll be there to give you advice and make sure you give you trusted advice. So don't think that, mortgage brokers are out there just to give you a mortgage. They will hold your hand throughout the whole process and make sure you get the right solution. So the right solution isn't always straight away. So you may hear, okay, you're not ready right now. You may have to wait 6 months, or you may be ready straight away.